Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. I am here again
with Craig Jeffrey
for another coffee break
session about four-letter insurance companies. Is this the one that you promised in the first one that would be about FDIC and SIPC?
Yes, this is the episode we alluded to. Last month we talked about what is FDIC, what is SIPC, what do they cover, what don't they cover, benefits, limitations, how do they make their money, all that good stuff. If you want that information and haven't heard it yet, go back, look at the links in the description, and you can find the episode there. Listen to those before you listen to this, because today we're talking about how is FDIC and SIPC different. You want to answer that for us, Craig?
Yeah, well, there's a number of areas that they're different. There's some similarities in that they provide a type of insurance, but what's covered is different. In addition to the letters that are different, FDIC, Federal Deposit Insurance Corporation, that covers deposits, savings accounts, checking accounts, certificates of deposit, things you keep at a bank. And there's a particular limit, $250,000 per tax ID per financial institution. SIPC has a $500,000 limit per customer with up to $250,000 for cash claims, but this doesn't protect the underlying asset, right? Your asset can still lose value, but it protects you against a brokerage failure. So just the fact that the amounts are similar, $250,000 and $500,000 with a separate component for cash of $250,000 does not mean that they're providing the same type of coverage. So balance in your brokerage account, the balance can lose value because it's not guaranteed by a company. It can lose value and it's not FDIC insured. There's SIPC insurance, which covers it if the brokerage fails. Whereas on your balance is your CD, up to $250,000 per financial institution per your tax ID, you are covered. You're protected. The bank stands behind it. The asset can't lose value, and the FDIC stands behind that and protects it up to $250,000. So different types of insurance coverage. They're both insurance coverage, but they cover different things. And they're actually, quite a bit different in terms of what they do specifically. They're similar in that they're both trying to provide confidence in the market, depositor confidence in banks in the form of FDIC insurance. And for SIPC insurance, it's to provide confidence in brokerages and those that invest in various securities to provide stability for the securities market, investing, in various types of securities.
Okay. So one's protecting cash, one's protecting an asset.
Yeah, your holdings, right? To make sure that they're not just lost or they disappear. The other elements, the other thing that's similar and different. So FDIC was formed in 1933. SIPC was created in 1970. Both came about as a result of great turmoil in the market. The Great Depression occurred in the U.S. from 1929 going forward. And by 1933, they had formed the FDIC to prevent runs on the bank by providing confidence in the banking system. And this was essential to have people put their money back in financial institutions, which allows for all kinds of borrowing and lending to occur to support a vibrant economy. So we talk about debt and capital markets, so that supports the debt markets, right? Cash is now kept at banks. In 1970, SIPC was put in place because there was significant challenges in 1968 up through 1970, as the history books read. And so this provided additional investor confidence in securities. So some of the capital markets investing in various entities.
Okay, so these two are wildly different. Do they complement each other in any circumstance, or they're just two totally separate areas?
Two very separate areas. So an individual may have money in a brokerage account that's covered by SIPC, and maybe it's you're dealing with that through your bank, for example, and that would be different coverage from here's my money in the bank that's in a CD, in a savings, in a checking account that's covered by FDIC. So individuals can be covered by both of these types of insurance. There's not really an overlap other than there's a reference to cash claims on the brokerage account. to make sure people get their cash back if there's a problem with the brokerage.
Okay. And for resolution, if there's ever an issue on a personal or company basis, is there anything you have to do to get your asset or funds back for either one of these? Is the resolution process different?
So on FDIC insurance, usually that's resolved straight away by the FDIC. There'll be a takeover. The Fed takes over an institution and puts it with another institution. Cash is available, and then people can withdraw their funds on a fairly orderly basis. From an SIPC perspective, if the brokerage fails and there's a hard time identifying your assets or getting them back because they're held and they're custodied and it takes some time, SIPC will help restore those to the owners. I'm not sure the timing, how quickly that takes place. I know there can be some delays. I don't know how long that takes. These are not common occurrences. FDIC usually seizes several banks a year. There's some years where there are none, but other years where there's multiple. Like in 2023, this past year, there was 5 or 6 institutions that went through a process that invoked FDIC or their actions prior to a more formal process.
Interesting. Anything else you want the listeners to know before we wrap the show up?
The key thing, whether you're a corporate treasury practitioner or whether you're an individual consumer, is to know that just because something says there's insurance coverage does not mean that is the same thing. Just because the same word is used does not mean that it is the exact same function. So SIPC, the coverage there is different coverage than FDIC insurance coverage. So when you see those bold statements, bank guaranteed, cannot lose value, FDIC insured, that covers deposits at banks. On the brokerage side, if it says not bank guaranteed, may lose value, no FDIC insurance, that's also saying these are different. These are different things. And you want to understand what your insurance coverage is. So when you have a loss, you're like, oh, I didn't realize it didn't cover flood, on your house or tornadoes or whatever it happened to be. Knowing what coverage you have and what coverage you need is really important. So that's really a key takeaway for people to know.
Sounds good. Well, thanks for sharing your insights. To our listeners, remember to tune back in every first and third Thursday of the month for another coffee break session.
Thanks, John.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.